What if the metal rushing through your solar panels, your electric car, and your smartphone was about to become one of the scarcest commodities on Earth? Most people know silver hit a new all-time high in 2025. What they don't know is why. On December 11th, 2025, silver touched $64.20 per troy ounce. That shattered the record that had stood for 45 years. But here's what the headlines missed. This isn't speculation driving prices. This isn't another Hunt Brothers moment. This is something fundamentally different. London's vaults are running dry. India is draining global supply at unprecedented rates. And the factories building our green future can't get enough metal to meet their orders. The gap between what the world produces and what it needs has reached 800 million ounces over just 5 years. That's roughly 1/3 of annual global supply simply gone. And the shortage is accelerating. Let me show you how we arrived at a moment when the metal that powers our technology revolution became the center of a supply crisis that could reshape global markets for decades. Silver closed 2024 trading around $30 per ounce. Standard price action for a metal that had spent most of the previous decade bouncing between $15 and $25. Then, January 2025 arrived. By February, silver had crossed $35. By March, $40. By summer, $50. By December, over $64. A 113% increase in 12 months. The rally wasn't driven by a single catalyst. It was driven by mathematics. Global silver demand in 2024 reached 1.2 billion ounces. Total supply from mines and recycling came to approximately 1.08 billion ounces. That left a deficit of 120 million ounces. The world consumed 120 million more ounces than it produced. Where did that metal come from? Above-ground stockpiles, vaults, warehouses. The reserves built up over decades. And those reserves were already under pressure. Because 2024 wasn't the first year of deficit, it was the fourth consecutive year. Between 2021 and 2025, the cumulative shortfall reached nearly 800 million ounces. Every year, demand outpaced supply. Every year, the gap widened. Every year, the reserves shrank. The Silver Institute had been warning about this for years. Their 2024 World Silver Survey laid it out clearly. Mine production remained flat at around 813 million ounces per year. Recycling added another 165 million ounces. But industrial fabrication hit a record 680.5 million ounces. Investment demand surged. Physical bar and coin sales exploded. Exchange-traded funds accumulated metal at unprecedented rates. The equation was simple. Supply couldn't keep up. What made this particularly dangerous was the structure of silver production itself. Roughly 70% of all silver comes from mines that primarily extract other metals. Lead mines, zinc mines, copper mines, gold mines. Silver is just a byproduct. This meant silver's supply curve was almost completely inelastic. Even as silver prices doubled in 2025, production barely budged. The Silver Institute projected 2025 mine supply would stay at roughly 844 million ounces, a 2% increase. Meanwhile, demand was projected to exceed 1.24 billion ounces. The deficit would widen to somewhere between 149 and 200 million ounces. Think about what this meant in practical terms. Every single month, the world was consuming approximately 12 to 17 million more ounces than it produced, month after month. That metal had to come from somewhere, and there was only one place it could come from: the vaults. In June 2022, the London Bullion Market Association held 31,023 metric tons of silver in its approved vaults. That's approximately 997 million troy ounces. London serves as the global hub for wholesale precious metals trading. When industrial users need silver, they source it through London. When investors buy exchange-traded funds backed by physical metal, that silver sits in London vaults. When mining companies sell their production, it flows through London's clearing system. The LBMA operates what's called an unallocated account system. Multiple parties can have claims against the same pool of physical metal as long as not everyone demands delivery simultaneously. It's efficient, it's liquid, and it works beautifully until physical scarcity hits. By March 2025, those London vault holdings had fallen to 22,126 metric tons, a drop of 8,897 metric tons. That's 286 million ounces that left London in less than 3 years. A 33% decline. Where did it go? 3 primary destinations. First, India. The country imports 80% of its silver demand. In October 2025 alone, Indian silver prices hit 170,415 rupees per kilogram, an 85% increase since January. That premium over global prices created massive arbitrage opportunities. Traders shipped silver to Mumbai and Delhi. Vaults in London depleted. Second, industrial users. Solar panel manufacturers needed silver for photovoltaic cells. Each cell contains approximately 111 milligrams of silver. That doesn't sound like much, but global solar installations exploded. China added 45% more solar capacity in 2024 than 2023. In 2024, photovoltaic demand alone consumed 232 million ounces of silver. That was 19% of total global demand. Compare that to 2015, when solar accounted for just 60 million ounces, a nearly 4-fold increase in less than a decade. Third, exchange-traded funds. As silver prices climbed, institutional investors piled in. ETFs backed by physical metal absorbed over 95 million ounces of inflows in 2025. Every ounce held by an ETF is 1 ounce unavailable for industrial use. The metal sits in allocated storage, locked away. But here's what most people don't understand about the London Vault numbers. The total holdings include both allocated and unallocated metal. Allocated metal belongs to specific owners. Unallocated metal forms the free float available for immediate delivery and trading. By September 2025, analysts at TD Securities estimated London's actual free float had collapsed to approximately 155 million ounces. That represented about 6 weeks of global demand. Historically normal levels exceeded 300 million ounces. The buffer had vanished. Think about what this created. London's clearing system processes billions of dollars in silver trades every day. But it operates on the assumption that physical metal is always available when needed. Under normal conditions, the system is elegant. Under conditions of severe physical scarcity, the system becomes a trap. Because the paper market for silver is vastly larger than the physical market, futures contracts trade at volumes that dwarf actual metal production. Unallocated accounts hold claims that exceed immediately available metal. As long as everyone doesn't demand delivery at once, the music keeps playing. But when the music stops, there aren't enough chairs. This wasn't new. In 1980, the same pattern appeared with the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt accumulated roughly 100 million ounces of physical silver between 1979 and early 1980. By the final months of 1979, they controlled approximately 1/3 of the world's privately held silver supply. The price exploded from $6.08 per ounce in January 1979 to $49.45 on January 18, 1980. A 713% increase in just over a year. But the Hunts used massive leverage. They borrowed billions through margin accounts to finance their purchases. When COMEX adopted Silver Rule 7 on January 7, 1980, restricting margin requirements, the credit dried up. The Hunts couldn't meet their obligations. On March 27, 1980, Silver Thursday, the market collapsed. Silver crashed from $21.62 to $10.80 in a single day, a 50% decline. The Hunt brothers lost approximately $1.7 billion. They required a $1.1 billion bailout from a consortium of U.S. banks to prevent widespread financial chaos. The lesson seemed clear. Don't try to corner the silver market. But that lesson missed the deeper truth. Silver's supply is fundamentally constrained. And when industrial demand surges while production stagnates, physical scarcity becomes inevitable. October 2025 marked the moment when theory became crisis. London's silver market seized. Lease rates, the cost of borrowing physical silver, had historically hovered near zero. In 2024, lease rates occasionally spiked to 5%. That was considered extreme. In October 2025, lease rates exploded above 40%. That meant if you wanted to borrow silver for delivery, you paid an annualized rate of 40% or more. The silver market had entered backwardation. On October 10, 2025, annualized backwardation rates reached 20%. Spot silver traded at a premium to futures equivalent to 20% per year. The message was unmistakable. The market was screaming for physical metal. Emergency measures followed immediately. According to CPM Group analysis from November 2025, London vaults received approximately 53.88 million troy ounces of imported silver during October alone. That was the largest single-month inflow in at least 9 years. Arbitrage from COMEX warehouses in New York. Diversions from Shanghai trading centers. Emergency vault transfers coordinated between major banks. Strategic ETF liquidations as investors cashed out at elevated prices. Air freight shipments replaced traditional cargo shipping. Airlines reported unprecedented demand for precious metals transportation. Industry insiders reported that in some cases, silver was being transported by plane rather than cargo ships just to meet urgent delivery demands. The scale of the October intervention was staggering. London required emergency imports equivalent to roughly 6% of annual global mine production just to stabilize for a single month. And the stabilization was temporary. The system remained under stress. Think about what this meant in practical terms. If you were a solar panel manufacturer in India in October 2025, you faced a choice. Pay record high silver prices plus massive logistics premiums to secure supply. Or shut down production lines. If you were a dealer with unallocated silver positions in London, you watched your counterparties potentially unable to deliver physical metal. If you were an investor holding silver ETFs, you owned metal trapped in vaults while spot markets screamed for supply. The paper versus physical disconnect had never been starker. Rona O'Connell, head of market analysis at StoneX, explained to CNBC, the risk managers in financial and industrial entities did not want to let any metal go out of the States for fear that it might come back in at 35% higher. That sentence captures the fear. Metal trapped by tariff uncertainty. Supply chains fracturing along national borders. And through it all, industrial demand kept growing. Electric vehicle production ramped up. Each battery electric vehicle requires 25 to 50 grams of silver, nearly double the 15 to 28 grams in a traditional internal combustion engine. Global EV sales were projected to exceed 60% of new car sales in major markets by 2030. The automotive industry alone would consume approximately 90 million ounces by 2025. Data centers and AI infrastructure drove additional demand. Artificial intelligence requires massive computing power. Computing requires servers. Servers require silver contacts, switches, and circuit boards. One estimate suggested AI-related demand could reach 170% growth by 2030, and solar remained the single largest growth driver. Despite manufacturers reducing silver content per cell through technological innovation, the sheer volume of new installations overwhelmed the savings. In 2009, each solar cell required 521 milligrams of silver. By 2025, that had dropped to approximately 111 milligrams, an 80% reduction per cell. But global solar capacity went from 40 gigawatts in 2010 to 2,000 gigawatts in 2024, a 50-fold increase. The math was brutal. Less silver per panel, but vastly more panels. Net result, massively higher total silver consumption. China's government committed $10 billion in subsidies for solar panel manufacturers. That was projected to boost silver consumption by approximately 5%. India pursued aggressive renewable energy targets. Every gigawatt of new solar capacity represented another pull on already strained silver supplies. The pattern escalated. Supply flat, demand surging, deficits widening, vaults emptying. By mid-November 2025, the silver price broke above $60 per ounce for the first time in history. On December 11th, it reached $64.2062, a new all-time record. The 1980 record of $49.45 had finally fallen after 45 years. But unlike 1980, this wasn't driven by cornering the market. This was driven by mathematics, industrial demand, physical scarcity, structural deficits. The Washington Post reported the metal had more than doubled in value since the start of 2025, posting a 102% gain year over year. Silver had outpaced gold, which itself had surged 59% to record highs above $4,000 per ounce. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, compressed dramatically. In April 2025, it had spiked above 100. By December, it had fallen below 65. Investors noticed. Retail buyers flooded into silver coins and bars. Mints couldn't keep up with demand. Online dealers added premiums of $5 to $8 per ounce above spot prices just to manage inventory. Exchange-traded funds saw sustained inflows. Unlike previous precious metals rallies driven by fear or speculation, 2025's silver surge attracted institutional capital, pension funds, sovereign wealth funds, family offices. But the human consequences were mounting. Solar panel manufacturers faced brutal margin pressure. They had contracted to deliver panels at fixed prices negotiated when silver cost $30 or $35 per ounce. Now they were sourcing metal at $60. Some smaller manufacturers shut down production. Others renegotiated contracts and ate the losses. A few simply defaulted. They couldn't fulfill orders because they couldn't source metal at any price that allowed them to break even. Small jewelers and silversmiths were priced out entirely. Electronics manufacturers that use silver in circuit boards, switches, and contacts faced similar pressure. Industrial users began hoarding. If you believe silver prices will keep rising, you buy extra inventory now. That behavior amplified the shortage. Metal that would have circulated got locked up in corporate warehouses. Supply became even tighter. Governments took notice. In October 2025, the United States included silver on its official list of critical minerals. That designation meant silver joined lithium and rare earths as materials considered essential for national security. China had already announced it would implement silver export restrictions effective January 2026. If the U.S. followed suit, the fragmented global supply chain could fracture entirely. Major banks upgraded their price targets. Bank of America raised its 12-month silver forecast to $65 per ounce. BNP Paribas suggested silver could reach $100 per ounce by the end of 2026 if supply deficits persisted. Those forecasts assumed lower real interest rates, continued industrial demand growth, and sustained investment inflows. The breaking point arrived when market participants realized this wasn't a temporary squeeze. This was a structural shift. Mine production couldn't scale fast enough. New mines take 7 to 10 years from discovery to production. Existing mines were already operating at capacity. Recycling could increase, but only marginally. The deficit would persist for years. As 2025 ended, silver trading stabilized in the low to mid $60 range. The October crisis had passed. Emergency shipments had refilled London vaults to levels sufficient for clearing operations. But stabilization wasn't resolution. The fundamental problem remained. In 2026, the Silver Institute projected another deficit exceeding 100 million ounces. Metal Focus estimated 30.5 million ounces. CPM Group suggested 206 million ounces. The estimates varied based on assumptions about demand elasticity and supply response. But every credible analysis agreed on one point. The market would remain in deficit. Industrial users adapted. Solar manufacturers accelerated research into silver-saving technologies. New cell designs like tunnel oxide passivated contact cells promised higher efficiency with potentially less silver loading, but they also required more silver per cell to achieve that efficiency. The trade-off was complex. Automotive manufacturers explored copper substitutes for certain applications, but copper's conductivity is lower than silver. Substitution worked at the margins. It couldn't solve the fundamental demand problem. Investment demand became the wild card. If investors believed the structural deficit story, capital would continue flowing into silver ETFs, coins, and bars. That would further tighten physical markets. But if prices peaked and investors took profits, selling pressure could overwhelm industrial buying. The history of precious metals suggests that corrections are inevitable. Silver has always been more volatile than gold. In previous bull markets, silver's rallies averaged roughly twice as large as gold's, but the crashes were also twice as severe. Regulatory responses shaped the market's future. If major producing countries implemented export controls, regional price disconnects would emerge. COMEX silver in New York could trade at different prices than LBMA silver in London. Arbitrage would become restricted. Liquidity would fragment. Some analysts argued the market would self-correct. At $60 or $70 per ounce, manufacturers would be forced to innovate substitutes. Philip Newman of Metals Focus suggested higher prices would pressure manufacturers to find alternatives. But others countered that the scale of the energy transition overwhelmed efficiency gains. Global solar capacity needed to reach 18,000 to 63,000 gigawatts by 2050 to meet climate targets. That required installing more solar in the next 25 years than had been installed in all of history. One research paper published in Science Direct in 2025 analyzed photovoltaic silver demand through 2030. Their findings were stark. By 2030, supply might meet only 62 to 70% of demand. The projected total demand reached 48,000 to 54,000 tons per year. Solar alone would consume 10,000 to 14,000 tons, representing 29 to 41% of global supply. With 72% of primary silver produced as a byproduct, significant expansion of primary output by 2030 appeared unlikely. Mining companies began exploring previously uneconomic deposits. At $60 per ounce, projects that didn't work at $30 looked attractive. 9 new facilities were in development, expected to add approximately 44 million ounces over the next 5 to 10 years. But 44 million ounces represented less than 4% of annual demand. The longer-term question loomed. What happens when above-ground inventories are truly exhausted? London's vault holdings could sustain several more years of deficits if emergency shipments continued. But eventually the well runs dry. At that point, the market faces a binary choice. Prices rise to levels that force genuine demand destruction, or supply somehow scales dramatically through new mines, breakthrough recycling technologies, or substitution across all applications. The pattern says the first outcome is more likely. Throughout commodity history, physical scarcity drives prices until demand adjusts. Copper in the 2000s, lithium in the 2020s, oil in the 1970s. The cycle repeats. Price spikes, demand destruction, increased supply response. Eventually, markets rebalance. But the rebalancing process is brutal. So let's connect all the pieces. In June 2022, London held 997 million ounces of silver. By March 2025, that had fallen to 710 million ounces, a loss of 287 million ounces in less than 3 years. Global deficits from 2021 through 2025 totaled approximately 800 million ounces. Mine production remains flat at roughly 813 to 844 million ounces per year. Demand exceeds 1.2 billion ounces and climbing. When the free float in London collapsed to 155 million ounces in September 2025, representing just 6 weeks of global demand, the market seized. Lease rates hit 40%. Backwardation reached 20%. Emergency shipments of 53.88 million ounces barely stabilized the system. That's not a functioning market. That's a market on the edge of failure. The pattern is clear. Physical scarcity, structural deficits, inelastic supply, surging demand. The same sequence that played out with the Hunt brothers. But here's where the 2025 silver shortage is actually worse than 1980. In 1980, demand was primarily investment-driven. When the price crashed, demand evaporated. In 2025, demand is primarily industrial. Solar manufacturers need silver regardless of price. EV makers need silver regardless of price. Their demand isn't optional, it's structural. The energy transition requires silver, and the supply isn't there. Those who secured supply early prospered. Those who assumed the market would always provide face a different reality. The only question is how long the deficits continue before equilibrium returns. The evidence says years, perhaps a decade, and every year of deficit consumes more of the finite above-ground stocks. Eventually, price must rise to levels that force genuine demand destruction, or technology must advance to enable large-scale substitution, or new supply must materialize. None of those outcomes arrives quickly, which means the silver shortage that emerged in 2025 will shape commodity markets well into the 2030s. The pattern never lies.